The credit rating downgrade in the US alone will not hurt Thailand badly. Coupled with lingering problems in Europe and Japan, however, a perfect storm may well be brewing. External risks are mounting, and they could pave way for a dollar liquidity crunch experienced a few years ago, said an economist. Standard & Poor's rating services statement released yesterday also supported this view, with Thailand highlighted as one of the countries in Asia-Pacific to be hit by export slump. He said in quotes, "What we witnessed during the fallout of Lehman Brothers in 2008 could recur, and then Thailand and the rest of the world would not be immune to the external risks." He noted that the global economy is on a downward spiral, especially if the debt crisis in Europe cannot be solved and if the US has to cut expenditures without additional monetary tools such as the third round of quantitative easing or QE3. He expected Greece to make headlines again in September when the International Monetary Fund and the European Central Bank make their quarterly assessment before endorsing another batch of bailout funds. Investors in Europe are wary that Greece may not succeed with its privatization plan, and this could further undermine confidence in the euro. While domestic problems will lower demand from the group of three countries, investment could be put on hold due to greater vulnerability. The Thai stock market continued its nosedive yesterday on negative factors in tandem with regional peers. Gold prices ended up above $1,700 per ounce, forcing gold traders of Thailand to revise domestic prices 10 times on Monday for a total increase of 650 baht per baht weight. In a statement, Standard & Poor's said that following the downgrade in US rating, there was no immediate impact on the sovereign ratings of Asia-Pacific region. Thanks to sound domestic demand, relatively healthy corporate and household sectors, plentiful external liquidity, and high domestic saving rates. Yet, it foresees long-term consequences. The US rating change, together with a weakening sovereign credit worthiness in Europe, points to an increasingly uncertain and challenging environment ahead as confidence is undermined. This indicates potential longer-term consequences of a weaker financing environment, slower growth, and high-risk aversion as negative factors for Asia-Pacific sovereign ratings. The statement also said that, given the interconnectivity of the global markets, an unexpectedly sharp disruption in developed world financial markets could change the picture. Especially Thailand, Taiwan, Korea, Malaysia, the Philippines, Japan, Australia, and New Zealand are likely to experience export-driven slowdowns either through weaker demand or lower export prices or both. As international liquidity may tighten, the implications for sovereign creditworthiness in Asia-Pacific would likely be more negative than previously experienced, and a larger number of negative rating actions would follow. Achara D. Bunmi, The Nation Analysis for ASEAN TV.